All right, today we're diving into what might just be the single most powerful idea in all of finance. Seriously, it's a concept that once you really get it, it's going to change how you look at pretty much every financial decision for the rest of your life. But first, let's start with a question for you. Imagine you're in a room and there's a box up for auction. You have absolutely no idea what's inside. How much are you willing to pay for it? Think about it. What's your number? Now, this isn't just some random thought experiment. This actually happened in a finance class at MIT. A professor, Andrew Lowe, walks in, puts a wrapped gift box in front of his students, and just starts an auction. And get this, the students had absolutely zero information. Nothing. Just the size of the box and, well, their gut feeling. So after a bit of back and forth bidding, things settled down, the hammer fell, and the final price, the market value decided right there in that classroom, was $45. One student paid up and walked away with the mystery prize. Okay, so here's the kicker. The student opens the box, and inside is a brand new iPod. Retail value? $150. That student got an amazing deal, paying just 30 cents on the dollar. So why? Why did the whole class undervalue it by so much? Yeah, the professor really hit the nail on the head. That massive discount had nothing to do with the iPod itself. It was all about the complete, total lack of information. Uncertainty literally has a price tag, and in this case, it was a whopping 70% discount. Now, what's absolutely fascinating here is that this little classroom game, well, it played out on a global stage, and it was a key part of one of the biggest financial crises in modern history. Just think about it for a second. That mystery box is a perfect stand-in for a complex financial security back in the 2008 crisis. You had investors being asked to buy this paper backed by mortgages, but they had no real clue about the future of the housing market or if people were going to pay them back. Just like the students, they were basically bidding blind. And this is exactly what happened with Fannie Mae and Freddie Mac, these two absolute giants of the U.S. housing market. When the market started to collapse, nobody, and I mean nobody, knew what their securities, their mystery boxes, were actually worth. The uncertainty was so intense, the government had to step in just to prevent a total meltdown of the system. So you see the fundamental problem here, right? When you're staring into an uncertain future, how in the world do you figure out what something is worth today? Well, this is where finance gives us an incredibly powerful framework to cut right through that fog. And it all starts with a kind of radical idea, a completely new way of thinking about what an asset even is. This is the first big mental shift we have to make. Just think about it for a second. When I say the word asset, you probably think of something physical, right? A building, a stock certificate, maybe a patent. But in finance, we have to look way deeper than that. And here it is, the definition that changes everything. In finance, an asset is not a thing. It is simply a sequence of cash flows over time. That's it. It's just a stream of payments you expect to get, both now and out into the future. So look, the key thing to get here is this. We don't really care about the brick and mortar building itself. We care about the rent checks it's going to generate. We don't care about the fancy patent document. We care about the licensing fees it's going to bring in. An asset's value comes from the money it produces. Period. Okay, great. So an asset is just a stream of future cash. But that creates a whole new problem, doesn't it? How on earth do you add it all up? How do you put a single value on that entire sequence of payments? This analogy just illustrates the problem so perfectly. You would never, ever just add 150 yen and 300 pounds together. It's totally meaningless, right? You'd have to use an exchange rate to convert them into a single currency first. Well, guess what? Finance says that money at different points in time works the exact same way. $100 today and $100 next year are like two totally different currencies. So if we want to figure out what an asset is really worth, our job is suddenly crystal clear. We have to take all of these future currencies, the cash from year 1, year 2, year 3, and so on, and convert every single one of them back into our one base currency, which is today's dollars. So what is this magical time travel exchange rate? It's a single, powerful number you've definitely heard of before, the interest rate. We're just going to call it R. And this one number is the key that lets us convert any amount of money from the future back to what it's worth to us right now, today. It's actually pretty simple. Here's how it works. To figure out what $1 next year is worth today, you just divide it by 1 plus R. To bring a dollar from 2 years in the future back to today, you divide it by 1 plus R. squared. And this whole process, this act of bringing future money into the present, has a name. It's called discounting. And the number you get, that's its present value. Okay, so now we can finally put all these pieces together. We can build the ultimate decision-making tool in finance, something called the net present value. And you know what? The process is actually beautifully simple. First, you just map out all the money involved on a timeline, the cash going out and all the cash you expect to come in. Second, you use that interest rate R to discount every single one of those future payments back to what it's worth today. And finally, you just add it all up. That one number you're left with, that is the net present value, or NPV. Let's run through a quick example. Let's say we invest $10 million today. We expect to get $5 million back in year 1, and then $7 million in year 2. Now remember, we can't just add those up. We have to apply our discount factor, which comes from R, to pull those future payments back into today's dollars. So you take those discounted future payments, you subtract what we paid up front, and boom, there's our answer. The net present value of this entire project, in today's money, is a positive $100,000. And this is the magic of it all. All of that complexity, different payments at different times, all the risk and uncertainty, it all boils down to one single number. And that really complicated high-stakes management decision, should we do this project, suddenly becomes the easiest question in the world. Hey, do you want an extra $100,000 today? Yes. Yes, you do. Decision made. And look, this way of thinking doesn't just apply to giant corporations. It applies to any choice you make that has costs today and benefits in the future. Deciding whether to go to college, buy a house, or even start a new business. So I'll leave you with this question. What is the present value of your next big decision?